Amazon up just 5% in 2025, while the S&P 500 gained 17%. That's a 12% underperformance. Hey, welcome back to lIHITRO Bank. My name is Adam. Wall Street is calling this the buying opportunity of 2026. Why did Amazon underperform? Two main reasons: consumer discretionary pullback and AWS competition. During 2025, consumers got more cautious with spending. Amazon's retail business felt that pressure as people shifted toward cheaper alternatives like Walmart and discount sites. Then there's AWS. Amazon Web Services is the company's profit engine, but growth slowed to 20% as Microsoft Azure and Google Cloud gained market share. Investors panicked. The stock got hammered. But here's where it gets interesting. Amazon's current valuation is identical to Apple. Both trade at a price-to-earnings ratio of around 33 times. But Amazon is growing faster. AWS just hit $33 billion in quarterly revenue, up 20% year over year. That's accelerating from previous quarters. Amazon's advertising business crossed $60 billion annually and is growing at double digits. The retail business, while pressured, still dominates e-commerce with massive market share. So you have a company growing faster than Apple, trading at the same valuation, but down 12% relative to the market. That's the setup. Wall Street analysts see this. 96% of analysts covering Amazon rated a strong buy or buy. The average price target is $295. The stock trades around $231. That's 27% upside if they're right. Some bulls like Evercore's Mark Mahaney see even more, with targets near 300. Now let's talk about 2026 catalysts. Federal Reserve rate cuts are boosting consumer spending. When rates fall, people have more disposable income. They buy more stuff. Amazon benefits directly. AWS is re-accelerating growth. Wall Street expects AWS revenue growth to hit 30% by mid-2026. That's up from 20% recently. Why? AI infrastructure demand is exploding. Companies are migrating to the cloud and adding AI applications. Amazon built $125 billion worth of data centers and AI infrastructure in 2025. That spending crushed short-term earnings, but it positions AWS to dominate AI workloads for the next decade. Here's the earnings story. Amazon's earnings per share grew 11% in 2025 despite massive capital spending. That spending depreciates over time, temporarily reducing reported profits. But the underlying business is strong. As those data centers fill up with customers, revenue surges while depreciation costs stay flat. That creates operating leverage. Earnings accelerate in 2027 and 2028. You're buying today before that acceleration shows up in the numbers. Valuation is compelling. Amazon trades at 29 times forward earnings. Microsoft trades at 30 times. Apple at 30 times. Google at 28 times. Amazon is right in line with peers, but AWS growth potential justifies a premium. If AWS hits 30% growth and advertising holds steady, Amazon could easily trade at 35 to 40 times earnings like it did in prior years. That pushes the stock to $280 to $300. Let's talk strategy. Rich investors are accumulating Amazon under $200 per share. Some got in during the dip to $210 in late 2025. They're targeting $250 to $280 by year-end. That's 15 to 21% upside plus whatever multiple expansion happens if AWS exceeds expectations. The thesis is simple. Amazon underperformed in 2025 despite strong fundamentals. 2026 brings better consumer spending, AWS reacceleration, and easier year-over-year comparisons. The stock catches up to business. For regular people without thousands to invest, fractional shares make Amazon accessible. Robinhood, Fidelity, and Schwab all offer fractional investing. You can buy $50 worth of Amazon stock, hold for 3 to 5 years. The compounding effect of AWS growth and retail market share protection should drive solid returns. You don't need to time it perfectly. Dollar cost averaging works. Buy some now. Buy more if it dips below 225. Build a position over time. Here's what money solves in this situation: the ability to buy undervalued assets when others panic. In 2025, investors worried about AWS slowing in retail competition. They sold Amazon. Smart money recognized a disconnect between stock price and business fundamentals. They accumulated shares. When sentiment shifts in 2026 and the stock rallies, they profit from the reversion to fair value. Amazon is a speculative play. It's the dominant e-commerce platform in the U.S. AWS is the largest cloud provider globally with 31% market share. The advertising business is the third largest digital ad platform after Google and Meta. Amazon Prime has over 200 million members paying annual fees. These are durable competitive advantages that generate cash flow year after year. The bear case is real, though. If AWS growth disappoints and stays below 25%, the stock could test 200 to 210. If consumer spending weakens more than expected, retail margins compress. If Microsoft or Google take meaningful AWS market share, that's a problem. But the probability-weighted outcome favors upside. The catalysts are lining up. Rate cuts help consumers. AI infrastructure demand is visible. AWS has a $200 billion backlog of committed customer spend. Wall Street's consensus is rarely this unified. When 96% of analysts agree on a buy rating, you pay attention. They're not always right, but the reasoning is sound. Amazon underperformed on temporary concerns while the business executed well. 2026 removes those temporary headwinds. The stock mean reverts to reflect business quality. If you're looking at Amazon for 2026, you're betting on AWS reaccelerating to 30% growth, advertising hitting 80 to 85 billion with steady margins, and retail holding market share while improving profitability. That's achievable. The infrastructure spend in 2025 sets up revenue growth in 2026 and beyond. Timing-wise, getting in under 240 looks attractive. Above 260, you're paying for optimism that's already priced in. This is a quality compounder trading at a reasonable valuation after a year of underperformance. Those setups don't come often in mega-cap tech. Amazon's not going to double overnight, but 15 to 30% upside over 12 months with strong businesses backing up, that's worth considering. If this breakdown helped you see the Amazon opportunity differently, hit that subscribe button right now. I'm covering the stocks and strategies that actually matter in 2026. Next week, another undervalued tech name that Wall Street is sleeping on. Subscribe so you catch it. Thanks for watching.